Hey everyone, welcome back to Corporate Decoder. Today, National Healthcare Properties Incorporated NHPBP just filed a material agreement, and it signals a significant shift in their property portfolio. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is selling off a large chunk of its medical facilities, and it is a move that has some big implications for their future. So what exactly is going on here? National Healthcare Properties Incorporated, or NHPBP, is a real estate investment trust that focuses on healthcare properties. They have common stock and preferred stock out there, like their 7.125% Series B cumulative redeemable perpetual preferred stock, ticker NHPBP. Alright, let's break this down. The company announced they've entered into an agreement to sell a big chunk of their business. We're talking about 86 outpatient medical facilities. That is a substantial amount of property. The deal is worth about $528 million. Now, this figure is before some costs and adjustments, so the final number might be a little different. Importantly, this sale includes about $278 million in secured debt, which will either be paid off or taken over by the buyer. This is a move that suggests they're looking to streamline their operations or perhaps raise capital. The deal is expected to wrap up sometime between July and December of this year, but it is still subject to things like the buyer doing their homework, which is called due diligence, and getting the green light from lenders. Now, why is this sale significant for investors? Well, selling off assets like this can signal a few things. They might be looking to focus on their core properties, pay down debt, or fund new investments. For a company like National Healthcare Properties Incorporated, which is in the healthcare real estate sector, shifting their property portfolio is a strategic decision that could impact their long-term earnings and growth. We've seen other companies in this space make similar moves to optimize their holdings. This filing itself doesn't contain detailed financial statements that show the immediate impact of this sale, as it is an announcement of an agreement. We'll likely see more specifics in their upcoming quarterly reports. However, the scale of this transaction suggests it is a material event that investors should be paying attention to. Looking at the broader picture, National Healthcare Properties Incorporated has about 31 employees. They also have different classes of stock, including common stock and preferred stock. For instance, they have a 7.375% Series, a cumulative redeemable perpetual preferred stock, and the 7.125% Series B cumulative redeemable perpetual preferred stock we looked at earlier. These preferred stocks are essentially like a dividend-paying loan to the company. With fixed dividend rates, the 7.375% Series, a stock is one type, and this is the 7.125% Series B stock. These dividends are typically paid out regularly, and there has been recent news about preferred stock dividends being announced. For instance, there was news in March about dividend announcements and payouts in April. There was also a note in March about their preferred dividend coverage improving as their portfolio grows. That suggests they have been able to cover their dividend payments comfortably. The report is signed by Andrew T. Babin, who holds the important titles of Chief Financial Officer and Treasurer. This is the executive responsible for managing the company's finances, which makes his signature on this agreement very significant. So, what is my take on all this? This sale of 86 medical facilities is a pretty big deal. It shows that National Healthcare Properties Incorporated is making a strategic move, likely to reshape its business. The fact that they're selling off a significant portion of their assets for a substantial amount of money suggests a deliberate effort to perhaps deleverage or to focus on more profitable or manageable parts of their real estate portfolio. One potential risk is if these facilities represent a core part of their rental income, then their future earnings could be impacted. On the other hand, if these were underperforming or requiring a lot of capital, selling them could actually improve profitability and reduce financial strain. The upcoming quarterly reports will be crucial in understanding the full financial impact of this transaction and how it affects their ability to pay those preferred dividends. The news about improved dividend coverage in March is a positive sign, but this sale introduces a new dynamic. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please like, subscribe, and join our Discord community from the description.